It's TopGunStockTrading.com, your daily market analysis, news, and views. All right, folks, let's get right into it. The S&P had a good day today, looking about 8.5 points. I have today's day has already been reset. So off the cuff, 1820. So up about a little over 10 points. The spiders going up just over a point. Dow Jones up about 100 points, and the Nasdaq up approximately 40 points. Again, I'm just swagging this. General market trend was all markets were up. What I'd like to get into is market stance or position and how we think the market's going to trend over the next couple weeks to the months and into 2014. As you can see, we have a top was put in about 4 or 5 days ago, 184.69, just before the new year, basically the last day of trading there, New Year's Eve, and that's significant in that these mutual funds and institutions wanted to get basically window dress their portfolios, stocks that they didn't have. They wanted to show that they were on their books into the new year to attract new investors. So there's some buying going on the last day of the year. Also, the Federal Reserve obviously wanted the market up into the end of the year and into this new year, to influence the small guy, the average investor, the retail investors, to continue to pour money in to their mutual funds. And December was one of the largest inflows. November, December, large inflows in mutual funds, and that's a sign of the top in the market. When the little guy, the average investor, gets into the market, the institutions are selling right into them, and you'll see the news come out pumping this market higher, trying to get the little guy to buy in, because after all, there are two sides to every trade. In order to sell, you have to have buyers, and that's how the institutions get get you, the little investor, the average investor, non-members of Top Gun Stock Trading, into this market, and then they sell it right into you. So another trick of the trade for these institutions is you'll see stock upgrades at the highs of stock charts. Real quickly, I can show you just one quick example I can think of right now is Apple last year. Now last year Apple traded up over $700, and during that time frame, just about 700 time frame, the institutions, I believe it was Goldman Sachs, came out and upgraded Apple when it was at 700 to up over $1,000, $1,200. Now, when that comes out, you know that the top is in, or a good indication that top is in that particular stock, because what they're trying to do is they've accumulated all down through here, and now they need to unload their positions at the top. They're not like you and me. They don't buy 100 shares, 50 shares, especially a high dollar stock like Apple. I mean, they have millions and millions of shares. So they just can't dump those out on the market because they're going to lose. There's not enough buyers out there. So what they do is they upgrade stocks, they pump stocks. CMDC is classic for this. And then they find buyers and they sell right into you. And as you can see, when the buyers run out and the retail investors have all gotten their shares of Apple, they continue selling, but obviously the price is going down. So it's a supply and demand function there. As demand goes down, they're still selling, it still goes down. So what you want to be, and what we try to get our members on board for, is you want to follow these big institutions. You want to pick up their scraps, so to say. You're the remora on the shark, right? You're swimming with the sharks, and these institutions are sharks. They'll take your money, and that's no beans about it. This market is certainly a transfer of wealth. And what we try to teach here is to obviously not be a victim of the transfer of wealth. And the best thing you can do is to read the charts, avoid all the hype and the news out there. Just read the charts and trade the charts. All right, enough of my fatherly advice right now. Again, there'll be more of this later on, and I have a proprietary trading system that I use that I will certainly putting together right now. So it's not ready for prime time production, but it's certainly a system I use and it has worked over the last 5 years that I've been trading. So back to the spiders. My stance on the spiders, like I was talking about, is neutral right now to bearish. And the reason why I am that is you can, like we talked about, this big high was put in on New Year's Eve, and now you have these big wide range bars to the downside. Until you get out or trade close above this high, 184.07 made on the 2nd, the day after New Year's. Until you close above that price, I'll be neutral to bearish. So what does that mean? Doesn't necessarily mean there's a trade in the spiders here. What it means or influences is potential trades in other stocks. So if you know what general direction the market is going, you kind of that will certainly influence other stocks' direction as well. Not completely, but it certainly has an influence on it. So it's good to keep in the back of your mind what your stance is on the market. You can see the light volume. If I bring up this volume, the light volume float through the holidays. And, not too convincing of a high made there on New Year's Eve. And once all the traders come back, you can see some of the selling comes in. You can see all the down days. You have higher volumes than the up days, and that just means these institutions are selling into the retail investor. Yesterday was pretty light volume. Only 86 million shares traded hands, and if you look at the 10-minute chart, you'll see that most of those, not most of that volume, but certainly about 12%, 10% of that volume came in on the last 10 minutes of trading at 7.5 million. I don't know what that percentage is, but it's, I guess it's less than 10%. But you can see 7 million is certainly a good chunk in a 10-minute period over the whole day. So a lot of that selling came in the last candle. Without that last candle, you're at 80 million shares trading hands, and that's pretty light volume, especially after the week after New Year's when everyone's back trading. So when this market goes up, it's not too convincing. Institutions aren't taking part. When it goes down, you see the high volume, and that's when the institutions are selling into you, or not you, but hopefully not you, the retail investor. So what am I looking at? What's going to convince me to turn my market sentiment? If this market can confirm, and confirmation is a proprietary trading technique we use here at Top Gun Trading, StockTrading.com. Very powerful tool. If it can confirm above this high, 184.07, then I'll change my stance to neutral to bullish. And certainly, if it can confirm above the high to make new highs, I have no choice but to go bullish at that point. But until it proves it to me, I'm still neutral to slightly bearish. What I'm looking for is a slight pullback into this 181.50 level. You see you have some support here or resistance in the past, which now is support. You can see it banged on this line here at approximately 181.65 to 70 3 times, which means it's pretty good resistance there, and resistance now becomes support when you get above that, especially when you confirm above that level. So 181, the 60 to 70 range is going to be my support level. And you also have that 20 MA, which is minor support, but it certainly helps that support line. If we can break through there, looking further south at master level, 181.50 is a pretty good level to have. And that's in the near term. This 181.50 is that level we were just talking about, and that's near term. That's the next 1 to 2 weeks. If we can confirm below that line, look for support around the 177.50 range to act as support. Again, you have some resistance, now it becomes support when the stock gets that. And you see it came down and back tested that back in the beginning of December. And then further support is further down. So I'll be looking to, if it gets down here, my trade's going to be at the 177.50 level if it gets down there. Now looking probably in the next month or two, possibly to it gets down there. But again, when it comes to these prices, in order to trade there, you have to have more than one factor. You just can't have one like a support line or a resistance line. You have to have other factors. That includes how it comes into it, basically the candlestick patterns that it makes in there. You have to look at the volume and the shape of the candlestick there, as well as time is also a big factor. Another proprietary trading technique here at StockTrading.com. Onto the weekly. If you look at the bigger time frame, because the bigger time frame is definitely more powerful, you can see that there is a slight divergence on the MACD, and I don't use the MACD all that often because it is a backwards looking function. You see down here I have a MACD. It's a backwards looking, meaning it uses previous day's data to chart. So you're not going to really, it's not a foolproof method of trading. So I just use it as one indicator or one input into my overall trading decisions here. And you can see the MACD at this point made a high with the market here at high, and then over at this point where we're trading right now, it's back up to that point, but the stock price has made a higher high. The MACD has not. So you see the MACD is flat, and the stock price is moving upwards, and that's a slight divergence, not necessarily as strong as we like to see. What we like to see is to show some strong divergence is stock price moving up, left to right, and then this MACD making a lower high. That would be some significant strong divergence, especially on the weekly chart. So does this mean this is going to go down tomorrow? No, not necessarily. It just is an indicator that there are some institutions that are distributing the spiders up here at this level right now. So again, this MACD can stay up here forever. It can stay overbought forever. It's just one indication that there might be a turn in the market or some weakness in the market, especially at the highs. It doesn't take a brain surgeon to know that the market's at the highs. You're probably not going to want to be buying the market at its highs. Okay, moving on. Enough on the spiders. Let's go to the oil. And what I like to do is just go through oil and gold and some stocks I have. So, looking at the oil market, as it pulls up here, I'm on the weekly. We'll go back to a daily chart, and you can see my support and resistance lines I have drawn in there for. They've been in there for a couple months now, and you can see it comes down here and about the $92 barrel level and gets there's some support there. So right now it just stopped going down here and starting to consolidate right above that level. That tells me that that level is no longer a major support level, that we'll have to look lower on the oil charts to find some support. There's double bottom here at 85.90, so probably looking for oil. Make it a small bounce here at this line, support line, nothing significant, nothing that's tradable, but the real buy is down here at $85.90 a barrel. We can't really, as a small trader, I can't really buy, why I say can't, I don't get into the oil futures market and buying contracts of barrels of oil. What I do is use the ETF USO, and that's the United States Oil Fund. Basically an ETF that tracks the price of oil. So what we have here, the chart looks pretty close, but it's not exact because the last chart is oil futures into the future, and this is an ETF that attempts to closely track that. So though it rhymes with the price of oil, it doesn't necessarily is the not necessarily the same exact moves, but it's close enough for our purposes. It's a tracking ETF. So I did have a buy here at 33.15 right here at this pivot right here that was made back on November 27th. Since this is starting to consolidate, again, we'll watch this, but if it continues to consolidate, I'll have to look lower on my price to buy the USO. So I've taken off my trade there to buy at 33.20, and I'm looking lower, and my new price is going to be 32.52. And as you can see, there's a pivot here off to the left made back in May of 2013, along with this trend line that I've drawn in going back to the lows in 2012, July 2012, and hitting this pivot. So you can see this trend line. If you can get trend line hits that are symmetrical, again, this is part of my proprietary trading technique that I'm putting together. If you can get trend line hits that are symmetrical, in other words, the distance between this hit and this hit is pretty close to the next hit on the trend line, that is definitely a more powerful tool, and you can trade that third hit there on that trend line. And usually, again, I get into the proprietary techniques that I've developed. Usually that third hit might undercut that trend line just a bit, but that third hit of that trend line usually is a pretty powerful bounce on that. So we'll be looking to trade that 32.52 level when it comes into it. Again, this is a weekly chart, so we'll be looking to be in that trade a little longer than if we were trading a daily chart. A weekly chart, I'm looking at maybe 5 to 6 days being in the trade, possibly 2 weeks worth of trading. But that's the most. If I'm looking at trading off a daily, I'm looking at maybe 2 to 3 days to be in that trade. So 32.52 is going to be my level that I'm going to buy that USO. Getting on to gold. I've been eyeing gold for the past couple months, trying to get a level that I like. Earlier, I nailed this level back in June on oil, and you see the big bounce. This level is a little lower. I've drawn in a new level here at 1156.30. You see it's come down to basically this double bottom here and got a bounce. So I'm not so sure about that 1156 level now. What we're looking for is some kind of pattern down here at the bottom. You can see it's trying to put in a bottom possibly in oil. I would like to see it get down to 1156 and then bounce, but the charts don't always do what I'd like them to do. Like we talked about before with the spiders and divergence, gold has a divergence as well, except it's a bullish divergence. So you can see this thing, pull it up for you. So as you can see, it's put in a intermediate high here, right. Well, it's not showing that right there. Let me weekly bullish divergence. We'll look at the weekly chart. It's not necessarily shown on the gold futures, but on the weekly GLD, which again is another ETF that tracks the price of gold. You can see that gold has put in a bottom here, puts in a top here right around these levels. It continues down through here, whereas the stock price is going left to right down, the MACD is going left to right up. So you can see that bullish divergence during that time as well. So we'll look again. The MACDs are backwards looking, so not something I'm going to trade off of, but certainly something to take note. We'll see what kind of pattern we get here. If we get some strong volume going in here, gold might be a buy here, a short-term buy here. And what I'm talking about there is, we talked about that support line that it came into that I've drawn up here. if you look at the volume on that, it is a pretty good volume on that reversal compared to the other, uh, the average volume, daily volume that has been trading. I lost my volume. There we go. So I'll look to show this to you. Here we go. So if you look back on that low that was put in, a slight undercut of the previous low, you can see that there's about 12.8 million shares traded hands, which is more than probably the average, probably double the average number of shares that were traded during that. So that's a good sign of a bottom, especially, or not necessarily a bottom, but certainly a pivot point, a near-term pivot point in the stock of price of the GLD. And you can see that big green bar reversal there, the gap down to an increase in price. You can see it certainly further gapped up, and this day looks like a fat finger trader out there made that trade, put in a market order vice a limit order, and lost some money for his hedge fund. That was an actual trade there for a minute or two. I'm not sure how long that lasted. But you can see gold made that big move up and starting to consolidate down. So what I'm looking to buy gold here is this gap fill level at the 116 level. So I'm looking at a Pearsall 116, and also need that pattern to work for me as well. So if it comes straight down into that level, probably not so good. If I can get some type of bullish and spirit of bullish flag that's working for me and kind of drifts into that level, then maybe I might be a buyer of the GLD. But it's going to need some more time there, and I'll update you on that potential trade setup as it progresses. Okay, there's oil, gold. We talked about the spiders. Let's talk about some trades I'm already in. I love doing the small caps, and January is the month of small caps. So what I'm looking at here, and I'm already in these trades, but I'm still looking for more trades. And I'll tell you, I'll just show you what I saw on these trades when I took them. So I got this big over here. This is an ASTM. I got this big move up, and then this inside bar drifting lower. So I made this trade when it was 344. So I'm over here. I don't know what day it is. I look at my log, but one of these days over here is about 344, and that's when I made the buy, because I knew there was support down here at this low. My plan was, hey, if it confirms below that low, then I'll stop out. Otherwise, I'll let this thing ride. And small caps, you have to buy small share sizes because they are risky plays, and then you have to give them time. So you almost have to play them like options. Another thing, stock trading. The biggest part of stock trading is money management. I can go on and on, but again, maybe I'll make a video of just money management, position sizes, because it's a lot. You have to get rid of the emotions and trading, because money creates pretty intense emotions when you're winning and when you're losing, both wild swings. So you have to be able to control and put those emotions in check. And one of the best ways I've found to put that in check is to manage your position size, so you make small wins. So if I use the baseball analogy, you're hitting singles and doubles. If I was trying to hit a home run every time. So you can see ASTM, I bought it at 344. It's at 393, so I'm up 50 cents. That's a good 15% gain. Again, I don't have a large position size, so it's a couple $100, no big deal. But the big thing is it is a couple $100. It's a single, a double, and you make, string a couple of these, 3, 4, 5, 10 of these things in a row, you'll be making some money. So ASTM's looking good for me. I'll be looking to get out of this trade right here at this closing price on this candle right here, which is 435. So I'm looking for 435, another 38 cents to move, and that 50 moving average is coming right into that. So that'll be pretty good resistance level and a good time to get out. Every time you make a trade, it's good to get to where you have an exit plan or where you're getting stopped out, and have an exit plan when you're going to make your target. So you don't want to get too greedy on the upside, and you don't want to get too scared, I would say, on the downside. In other words, you don't want to stay in a trade too long. That's how people lose money. So our goal here at TopGunStockTrading.com is to go 70% winners, 70 to 80% winners. Now, somebody could bet 70, 80% and still lose money. So those 7 or 8 trades that he is profitable, in 2 to 3 trades he's not. In those 2 to 3 trades that he loses money, he does not manage to trade and loses big. In the 7 to 8 trades that he does make money, he's pretty smart about it and cautious. It takes his money and runs. So if he loses more in his 2 to 3 trades than he makes in the 7 to 8 trades, you can see how you can still lose money batting 700 in the stock market. So you can see a big part of trading is money management and managing your trade. So moving on to another small cap IM and CVM. Again, these are pharmaceuticals, and the month of January is awesome for small caps if you can find it. So this trade I got in at 58 cents here on this day, gap down below there, below my level, right to my level. Opened at 58 cents, that's where I got in. It went down as far as 53 cents. I like the price action in here, so I stayed in the trade and just held on. Like I said, you need time. Small caps need time. They need news. They trade small, light volumes, so the price patterns and the times don't always work out like the larger caps do with all the volume. So you need time. You need some news. You need sentiment. So I'm still in this trade. I took half off at 70 cents. Right here at the top of this candle, I believe. Yeah, 71 cents, but I took at 70 cents because such a small cap, it's a low volume trade. I usually set my targets just below where I think the stock's going to go to. That way I ensure that I'll have buyers there at my sell price. So I usually set a little bit lower, so I got out 70 cents. As you can see, it's traded a little bit higher. No big deal. That's good. I still have half my position in there, and we're going to set a break-even stop so they can't take. This trade is going to be guaranteed to be profitable. Again, managing your trade is a large part of the stock trading and being a profitable trader. Okay, Clean Air Technologies. I like this stock because it's above the moving averages and it's putting in a bullish consolidation. So again, you're going to need time on this trade. So I got in this trade at 580. Probably paid a little bit higher than I should have. It went up to 615 and it's come back in to 573. Again, I don't have a large share size, so these 25, 30 cent moves, no big deal to me. I'm looking for the bigger move up here to $7. Maybe this gap fill, hit this higher here. So a break of 7 is what my first target is, and I'll let this thing play out. Okay, if this thing can base here right above these moving averages, it'll pop up there. It'll be prime. So we'll look on to that. We'll do one more small cap here. DARA, another pharmaceutical. Got this one at 50 cents down here. And again, large green bar, bullish consolidation, came into the moving averages. I bought it at 50 cents, and it's since popped up there. So again, I'm looking for a target of around 70 cents. Basically, the high of this, there's going to be some resistance. If it can base, I will change my target if it can base above this 200 moving average, build some consolidation, and it might go even higher. So I might have to move my target up a little higher, higher than 70 cents. Okay, enough of the small caps. Some of the large caps I'm in. This video is getting really long, but yeah, I just wanted to manage my, show you what I got out there. I shorted Boeing yesterday, and I shorted it right here at this opening price here, 140.25. As you can see, it's a little higher than that. It's 25 cents higher. But no big deal. And the way I played this stock was I sold a vertical spread on that. So I have options. So what I did was I sold a 140 call and I bought a 145 call. Basically, that's a bearish bet. It's called a bear call spread, vertical spread. And basically, what I'm saying is the stock's going to be below 140 by the option date. The option date on that I bought out to February. February 21st. I don't do a lot of options. Sometimes I'll buy spreads, especially at these market highs, because stocks can be overbought for long periods of time. They can get that euphoria and be Teflon proof, and they continue to go up without any rhyme or reason. So a spread is a way to play. You put less risk at risk, and you make a couple $100 in each spread depending on how many contracts you put on or you sell. But that's my trade right there, 140.25. I will get out when I get confirmation above 142. So I have a pretty tight stop, especially with a vertical spread. Probably risking 25, $50 at most for a gain of 150 bucks. Again, the spreads take longer to play out because you're basically selling theta in the option there. So you're selling time in the option. Options decay over time, and you're selling that to somebody. So they take longer to play out as the spreads do. Obviously, if you're just buying straight up options, you can buy and sell. Those things can go up and down pretty fast. Another stock I have is Caterpillar, and I sold again. I put another spread chart play on this. Another bear call. Excuse me. Did I say bear call spread on this right here. This trend line. I like playing trend lines, and this was the fourth hit of this trend line. You can see the third hit of this trend line, like I talked about before, pretty powerful move to the downside. The fourth hit of the trend lines, trend lines get a little bit weak at the time. Again, they'll punch through there, and it still comes down. Now, the more times this thing hits this trend line, the less powerful it's going to be. So the next time it hits that trend line, it definitely won't be playing that. Not a good play. Even a third, fourth time is less assurance, should I say? Certainly, if you obviously you need 2 points to make a line. So the third one is the best one. The fourth one, I probably won't get as big of a pullback on this one. So what I did on this is I played a vertical spread. I believe this is a January strike price. And it's playing out well for me. We'll see how it goes. I'm going to look to get out of this soon, but what I'm looking at is because it's going to expire soon. When I'm looking at this big wide range red bar, which is I saw that the other day and I was like, I was pretty happy about it. What we'll see is probably some inside bar actions for a couple days. And hopefully it breaks through that 20-day moving average prior to this this expiration here on the 17th of January. So when I play options, if I'm playing spreads, obviously I'll keep them to the expiration. And again, this will be another video I can make for you. But when I'm playing single options, I look to buy a couple months out and in the money by a large amount. And that gives me time, basically, to play for that stock to play out. And I look to sell an option no later than 2 to 3 weeks. 2 weeks is definitely, I'm getting nervous from the expiration. Certainly 3 weeks before expiration is my time I'm looking to unload that thing. And certainly I can unload it beforehand if my stock reaches the price target. I'm going to unload it beforehand, way before that. But certainly you don't want to get inside 2 weeks with an option because the decay on that thing will wipe you out. So you buy a couple months out, you buy in the money options, and you look to unload them. 3 weeks is where my goal is to get rid of that thing before the decay starts to hit. So there's Caterpillar. I am in other stocks here, but there's too many to go through. I'll give you a couple plays I'm looking at to get into. One is Bank of America. You see some of my lines here. Remove those. Some of my trade setups that I was looking to do while this video is going on. Probably not going to be a good one to put online, but we'll see. Not a bad one to start off with. So, Bank of America, all-time high, 1679. I used a proprietary technique. You can see it hit 1679, pulled back just a little. You got a large outside day there. That tells me that that's going lower. Now, if I can get a pop above 17 today, a 50-cent pop, maybe, and then sell, I'll be in the money. So I got a $17 trigger. That's probably a little bit on the conservative side. You could probably go somewhere in between, probably halfway. Probably 1665, 1670 is probably a more aggressive, but it'll probably work out for you as well. And what I did here is I sold another spread, or I'm looking to sell a spread on this with the February expiration date, so I think that thing is going to go lower. Again, all these all-time highs. You can do spreads, you can do options, you can sell it outright, which is not a bad idea either. So that's BAC or Bank of America. A Chinese play I'm looking to get in, if it gets down to my level, would be sweet. Is VISN, Vision China Media. I'm looking to get in this at 1672, and you can see I drew a fib retrace top to the bottom. It's perfect 50% retrace. You can also see there's some past resistance and retest of that line at 1672, just below the 20 MA. This 20 MA is going to be probably minor support at that time. We might get a little small bounce there or pause day there. Hopefully it comes right in at 1672. Again, I'm looking for other factors as well. If it can show them to me, that's a dead on buy for a long trade there at 1672. Again, you can see the wild stock price action on this stock. So this is another point where you want to manage your trade, manage your position size, so you keep the emotions out of your trade. So it's been down as low as 9, all the way up to 30, and it's back down to $20 stock. So in the last week or two, it's lost 33% of its trade. So you want to go smaller position size. Now on this type of trade, I usually do 5% of my account size, maybe even 2.5%, just so I can manage that position size and keep those emotions in check. One more, I got Coach. I want to share this to you. You can see it. I think it's a fake print. I went down there 1 minute below my buy price. I didn't get filled. My buy price is at 55.17. I have a master level there at 55.17, and that's what I'm looking to buy that. All right. This video is long enough. Hopefully, I've kept some of you's attention. Again, near-term neutral to bearish stance, and we're in some stocks here. If it gets above the 184 level, confirmation, probably neutral to bullish. If it gets below at 180, 150, I'm looking to go to bearish. And again, I'm looking to trade, go long the market at 177.50 level. All right. Thanks for attending, and I'll have another video for you tomorrow. See you on the charts.